So hello everybody again. This is another podcast from Magnate Assets, another one in the series I like to call Beyond Big Ben. So we can discover a little bit more about UK property investment. Today I'm joined by Jack Woodall, CEO of Atlas Property Group, based out in the Middle East. And today we're actually in Manchester, and me and both Jack are Manchester lads. We do represent the red half and the blue half, but I'm sure we can get through this podcast. I'll let you guess who supports who. Jack has been working in the Middle East for a long time, probably 20 years plus in UK real estate investment, and working with probably by now hundreds of investors.
So. Yeah, I think so.
And advising them on property investments in the UK, background with big developers like Select and so on.
Yes, that's right. Yeah, I've been working now, I think, in the Middle East for 12 of those years. But yeah, overall in property now, going up to 15 years in property. It's a long time.
Jack has kindly give up his time for me today on a trip back to the UK and trip back to see, I think, friends and family in Manchester. And I think me and Jack have been working together probably for a couple of years now, and we've been doing various different, we're doing some seminars and some events we've done through Middle East and Saudi, and so on. So I wanted to sit and have a chat with Jack, really, to get his input and take on why UK property is still interesting, and there's a lot of interest from Middle East investors, and why that is. And actually, before we just met, I saw an article. So the UK is made up of all the different regions, and London and the southeast and the southwest, and then get to the cities like Manchester and Birmingham. And there's a great article that came out that's showing the capital appreciation over the last 19 years. And I think, maybe Jack, you'll know this, recently in the last few years there's been a lot of talk of the regional cities and how they're performing, and maybe London's at that point where it's had its cycle and it needs to kick and go again. But in this report, there's 119% London.
It's a lot, isn't it? Yeah, exactly. I think we were both surprised at that, weren't we? Just how much London has grown, shall we say, over the last, 2 decades. And I think from all the noise you hear over the last 5 or 6 years, you expect that to be different, or I would have done anyway. I think I was guessing that one of the regional cities, such as our wonderful Manchester, would be at the top of the list, but it isn't, and it's quite significantly London over that time period.
That's right, it's like 40% more than the nearest one, and the nearest one it was like twice as much as Manchester.
Yeah.
But the article does go on and explain, other things in terms of that, and I think I understand the cycles involved in that, and a lot of it, the UK is driven by property shortage. This current government's trying to build 1.5 million new homes in the next few years. So when wages go up, salaries go up, and it's quite interesting in the regional cities, it's saying that the ratios have actually improved. So I think there's going to be room really in the regional cities where that's going to push property prices up, as people are making or earning more money in that.
Yeah, absolutely. And I think you can see that in day-to-day life as well. Like you rightly pointed out, is that we're both Manchester boys, and I've been living in the Middle East for the better part of the last 10 years or slightly more. And yet when I come back here, I'm always surprised because there's so many more people, there's so much more traffic, which is a bit of a downside, because that's everyone has that opinion of London being so busy, but Manchester's getting that. And I feel like with that kind of knock-on effect where people can afford now to live in the city centre, you're sort of seeing more and more people come here from job opportunities to affordability, and maybe what is slightly London's loss is coming towards the regional cities like Manchester. So you are seeing a lot more people live here, which is good to see. Nice to have a little bit of a buzz around Manchester at the moment.
I mean, what do you think? I mean, if we stick with London in terms of where it's at, where do you think, what do you think is next for London in 2025? Where do you think?
Well, it's a good question. It's a good question, because I feel like over the last 5 years, there's been a little bit of a subdued market there in London, because the pandemic and the slowdown, probably post-Brexit as well, as you saw, probably a little bit of almost in some cases negative growth when you look at some of the reports. And if you have a look now at most of these findings, when like for today's report that you showed us, where London has had the lion's share of growth over the last 17 years, a lot of people are kind of hinting that maybe now we're on that slight upturn angle, and especially in the kind of prime areas of London as well, which is interesting because that hasn't really moved over the last 5 years. But if you have a look at those zones 1, 2, 3, and especially with the new Crossrail, with the Elizabeth line having much more connectivity, it's showing these little subprime areas just outside of your central zones being, a very good opportunity for investors. We seem to have like upwards trends. So I think for what's next for London will always be an attractive point because it's the financial hub of Europe essentially, and the capital of England. So a lot of job opportunities, a lot of people living there, a lot of demand for property. So I don't think that will ever go away. In terms of pricing, I think if you're a savvy investor and you're picking up on these little infrastructure, shall we say, regeneration zones, like in East London is a great example of that. 70s, 80s, even early 90s, East London wasn't a popular zone, but now you've got all these areas popping up, along the river, Greenwich, Woolwich. Now we're going closer towards where Poplar is. There's a lot of these zones that haven't been touched. So there is some very, very interesting angles for people to consider London as their next investment, because I still feel like we've got some good room for growth in areas that previously were a bit untouched.
What do you think the price point is on those kind of investments?
Yeah, London's one of those areas where you can be in one area and price is X, and you walk 5 minutes and the price is Y. And we've seen that quite historically with somewhere like Mayfair, for example, where the price jumps up dramatically in certain parts of Mayfair. But I think if we're targeting the investment zones, or what I would call those investment zones that have this regeneration or new infrastructure, like the Crossrail. So if we look at the path of the Crossrail and kind of look towards east, I think is a big opportunity there. Even Canary Wharf, for example, is a really good part of London to look at. There's a lot of, obviously a lot of the office towers and things where a lot of people are commuting to work, and surrounding Canary Wharf. I think price point wise, 1-bedroom apartments there are sort of around £450,000 starting price, which is a really good price for central London, and effectively zone 2 London there as well. But that all plays into what we've just discussed about this new transport system and these kind of untouched areas of London now getting the love that they probably deserve. So I think, starting around £450,000 is a great price point, and you compare that to something that is maybe a 10-15 minute tube ride away into zone 1, and those same size apartments, same quality, are 750, 800,000, almost double.
Yeah. How do you think then, we've said before in terms of we've London, and then we look at the regional ones and we're a bit surprised that London's grown so much, and then you look at some of the regional markets. We're obviously Manchester guys, we spoke a little bit about Manchester before.
Unfortunately, you mentioned my football team as well, which the less said the better.
So if you think about then the regional markets around the UK, because what was surprising in that information as well was there's a lot of talk about the northeast of the UK, and the fact that you've got Newcastle and Durham and that Northumbria and that kind of area, it's a lower price point, the yields are great, and yet they've seen the lowest capital growth in the last 17 years. So how do you think that jigsaw's going to fit together from a regional point of view?
It's an interesting one, isn't it? Because I feel like, you mentioned slightly before that real estate comes in cycles, but I also feel like there's a lot of investment, government-backed investment, into infrastructure in the northeast and the northwest, with Manchester, Liverpool, and the Midlands as well. Birmingham, Leeds, all seeing a lot of love. And I think infrastructure's massively important to property. And we find that a lot with our Middle East investors. A lot of the time they want to know, well, where's the train station? How far is it to London? And it's just having that connectivity. And also from a tenant point of view, if there's better transport connections to other parts of the UK, it offers freedom of affordability. And what I mean by that is you're able to live in these cheaper locations like Newcastle, Durham, Manchester, Liverpool, and commute to London or various other hubs in the UK with ease. So I think we didn't have that, or we had a lot smaller versions of connectivity and infrastructure 20 years ago. So London led that lion's share of growth. And I feel like now, I think if we had this conversation in 10 years' time, that graph is going to look a lot differently. And I think demand is going to drive that, and you can see the demand increasing in those areas. And I know we focus on Manchester because we're from there, but I read recently as well a report that there's 100,000 more residents expected to be living in Manchester over the next year. And that's in the city centre. So in 2026, the council put out a report to say that by 2026, there's going to be 100,000 more residents living in the city centre. And it surprises me because you sometimes speak to clients or you show them around Manchester, and you've walked around Manchester recently and you see the cranes and you see the mass towers that are being built in these regional cities outside of London, and you could almost mistake that for oversupply if you were walking around and going, well, who's going to live there? But the numbers and the job creation that's happening in the city is backing that up, and if anything, we need more. So I think going back to your point is these regional cities are now getting the love from the government that they deserve. And you know, there's a few controversial points in there, the HS2 being the high-speed network rail connecting Birmingham and London, and Manchester was expected to see that, and Liverpool at one point were expected to have a station that connects it. And for the time being, I think that's been squashed, but it hasn't stopped the government from investing in those cities with their own local connections and train lines and bus routes and metros and tram stops. So all of this is just, like I say, going back to that point of being given freedom. If you're living in the UK, you no longer have to see Manchester or Birmingham as the only options outside of London. You've now got Newcastle, Durham, Liverpool, and some of the Midland zones like Leeds, for example, who are also benefiting from this. So it's interesting.
I think like Birmingham, the HS2 connection time is 49 minutes. So people are talking about, I think one of the banks, HSBC, is actually encouraging some of their workers to look at Birmingham from who actually work in the London offices in terms of the times, because obviously as well as some work from home time in that.
Well, it's not just that, it's the affordability of living. You know, in terms of food, you get a coffee at Costa in London and it costs you £7. Get a coffee in Costa in Birmingham and it'll cost you £4 or something like this. So I feel like if you can still do the same job, same salary, but ultimately have more disposable cash, and that leads into the rental side of the market as well, because we've seen a mass demand over the last 15 years of city centre apartments, and that convenience of being next to these infrastructure hubs of the train station or wherever to live and commute, like you just said, and go to these big companies that are now either setting up a regional office in these zones, or they're quite, shall I say, intelligent about where they are sending people. There is easy commutes to these offices from Birmingham, like you say, and the high-speed network rail in 49 minutes. I've got friends that live in London that can't afford Zone 1, and it takes them an hour and 10 minutes to get into the city for their job. So for those guys, they can move away now from London and those outer rings and use your Birminghams and Manchesters or these hubs that have good connectivity to London and split their cost of living in half.
And then if you look at, I think, the spending review that came out yesterday with the government, a lot of money is ring-fenced for that infrastructure improvements away from London, like the north and northwest. I mean, there's even been talk before about the under the Pennines tunnel to link both sides of the country, which would be interesting. If we're going to put Yorkshire and Lancashire together, that could be interesting based on history. But I think the infrastructure is like you've said. I mean, you've seen that around the UK, and even through London and the Elizabeth line, and you look at all the other infrastructure projects that go on, and that's really where property, if you look back over the history of it, property's done it.
Exactly, yeah.
if I was to toss up now and say to you, which city would you think would be the best place in terms of investment? Which one would you, a regional city that is, which one would you think is showing?
A regional city, so we're not including London in this.
No, I'm the investor sat here opposite you, Jack.
And you wanted something outside
I've got
of London.
some money.
Yeah, I think.
Jack, what do you think?
Do you know, you're putting me on the spot now. I'm always going to say Manchester from a personal perspective, and I'm very biased towards a city. However, I do think at the moment maybe I would be more inclined to look at something like Liverpool and look at those cities that perhaps haven't had as much love over the last 5 or 6 years. They've not seen huge amounts of growth, but if you follow those key indicators, like we were talking about infrastructure and the money that's being ploughed into the city, those are all really good key buying signs that investors should pick up on. And I think if you look at the price perspective as well, I mean, you'll buy a one-bedroom, a decent one-bedroom in London, like we spoke about before, Zone 2, for £450,000, let's say. And yet in Liverpool, they start £160,000, £170,000. So from affordability, then I would think probably the northwest and Liverpool would probably be where I'd be putting my cash right now.
I mean, there are some big projects in Liverpool. I mean, they've just completed Moore's Dock, which is a big one on the new ground for Everton and all of that infrastructure that goes in there. And I think there's another £1.5 billion that's earmarked to continue with
this is it,
the development of Liverpool.
And it's those little things that you should be picking up on as an investor, and what we tell our investors as well when we put out our news articles or give them updates on the UK market, is these little indicators are great to pick up on. And even though you're not too familiar with the city as an international client, I think most of our investors see London as the UK, and they don't know any of the regional cities unless they've been to university or they've had kids that have gone to one of the major universities outside of London. But that should give them confidence that if the UK government is ploughing millions, and in some cases billions, into these cities, it's a safe bet. And that's what I would look at from an outside of London focus.
I mean, a lot of people know Liverpool because they are the Premier League champions.
Don't remind me. Yeah, they are. Hopefully not for too long. And this is it.
I think as well, obviously there's notoriety from that. I mean, I've got history in terms of the football team. We'll move away in terms of that. I mean, again, what other things you think are relevant to an international investor looking from a perspective of I mean, for example, we could talk about exchange rates and things like that. What kind of impact have you seen with that in the market?
Well, I think very recently it's been a huge positive, because if we look at and focus particularly on myself, I'm based in Dubai and the Middle East, and we have the dirham, which is pegged to the dollar. And right now there's a huge opportunity where the pound is devalued by around 5 to 10%. So compared to, say, this time last year. So if you're buying now, it's actually costing you less dirhams to buy the same value property it was last year. So it's not just about finding the right location and the right property, but it's finding the right time as an international investor to buy, and utilising the currency and perhaps a forex trader to lock in certain rates rather than your bank, because most banks will, take liberties when it comes to fees and things. So working with these right channel partners in that purchase process as an overseas investor is incredibly important, and taking note of these certain times to buy as well, because an extra 5-10% profit is, a big margin when it comes to investment property, especially investment property in the UK that is inherently stable for a multitude of reasons. But I think there's an opportunity right now coming towards the back end of 2025 to be investing, and not just with currency. We're seeing that even with mortgage rates and interest rates dropping, which is creating this kind of wave of new interest in the market, whereas last year we saw the interest subdue and we saw sales decrease as an overall for the UK market. Home sales had come down, and that was because interest rates were high. And now we've got a lower interest rate, and it's expected to drop again, I think, towards the final quarter of this year. That I think that's just going to bolster these sales again, and new mortgage options, even for international investors. We're seeing that with like bespoke tailoring options in London specifically, and slowly these mortgage lenders will branch out to these regional cities that we discuss, but they see London as the safe haven. And for internationals, that's good to hear, because it means that even though you don't live in the UK and perhaps don't have a business here or any other income, mortgage options are available to you, and there's a multitude of different ones, Sharia-compliant ones as well, so it is opening up more doors and increasing sales.
Because I think that's one of the things I've come across, I've learned over the time, is there's a lot of misconception around the finance that is available to expats and overseas investors, into thinking that, it's all around, well, I don't have an income, this is my age, I haven't got a visa for the UK, how can I borrow money for the UK? Well, in terms of the UK, the buy-to-let finance is unregulated, it's commercial lending, and the lending's based on the value of the property. Does it stack up? Does the rental income cover the interest or the charges for the mortgage? And clear it by a certain percentage, and we can work out percentage we can lend, and we'll put something together.
Yeah.
And of course, with interest rates coming down, I think now you're seeing off-plan with longer dates becoming quite popular, because people understand the mortgage rates are going to come down.
Yeah, well, this is it. Yeah, we've got that very recently, where most of our clients who are inquiring now on properties will want something that is off-plan, and not off-plan by 2 or 3 months, but have we got anything with a payment plan over the next 2 years? Because the feeling is that interest rates will come down, and naturally it means cheaper lending. But there's a good point there that, as spending so much time in the Middle East has taught me that most of the off-plan opportunities in, say, Dubai as an example, they will require quite hefty payment plans up front of, say, 60, 70, sometimes 80% before the project is ready, whereas the UK is typically 10, 20% down, and the rest is on completion and handover of the property. And that opens up the mortgage market to off-plan purchases, because you don't need 60, 70% in cash over the build. You can put it in a very, very small amount right at the beginning, and then leverage the majority of the balance payment on completion as well. So I think, it's a good point that you make. I think mortgages are definitely something clients overseas should utilise now, but do have a lot more options as well, because it hasn't always been available. And I think what's interesting now is we're seeing more and more banks put together tailored packages for international clients.
Yeah.
So there's one recently, for example, with a prominent London developer that we work with, and we were out in Saudi Arabia and discussing investing in London with clients from Saudi Arabia. And they put together a package with a certain lender in the UK where the interest rate was 4.33%. Now, for last year, the average interest rate we were getting for buy-to-let investors was 6%. So that's come down by nearly 50%, which is a big, big margin to play with. So we are seeing those kind of attractive interest rates now come back into the market, and seeing these tailored options for international clients, which again is furthering kind of foreign direct investment into the market, which is good to see.
And I think as well, it's getting across the point as well, the fact that if you want to leverage in the UK, you want to buy to let, it's more or less interest only. So you're only going to pay the capital back when you sell the property in the future. The property value is always going to go up. We know, like, for the last 17 years, London made 120%, it's always going to go up. So the loan to value ratio on the capital is always going to be dropping. And I think sometimes this is a concept that you've got to understand, in that if I'm taking a lump sum of money, I can actually invest it in multiple properties if I'm going to use that bank finance.
Yeah.
And then I'm going to get capital appreciation on more properties for the same capital. This is why you make more money.
Absolutely.
But I think people have just got to understand, I owe the bank money, but not all debt is bad.
Yeah.
It depends how you manage it sensibly and use it, because people in the UK tend to invest and then take some funds out and buy another one and build it up, and then sell a chunk and keep the rest, pay the mortgages off, and I've got a happy retirement income coming in. And I think, you've got to think a bit more long-term strategy and think about how you use that bank finance. And I think that's what people sometimes don't understand completely.
I agree. I think debt sometimes has a really negative connotation to it because of the word. A bit similar to tax. Nobody wants to pay tax, but there are certain ways for you to utilise debt. And most big corporations around the world are run on debt, and they utilise debt in the right way. And investors should also do that with the right package and the right mortgage. And that's why I always suggest to my clients, rather than seeking out your own independent bank and trying to get a mortgage from them, utilise a mortgage broker who has knowledge of the market, that's done it for the last 10, 15, 20 years, and get their experience on your own personal circumstances, what your other assets are and your other liabilities are, and then come up with the best package surrounding that. And typically it is interest only, like you say, so that you can utilise your own capital and perhaps invest in multiple different options rather than just one, and focusing on a larger down payment or trying to pay that interest off before you sell the property. Like you say, utilise your own capital profit at the end when you sell. And hopefully London does see that cycle again. I'm a bit dubious whether it'll be 120% or whatever the reports showed over the next kind of 10 years or so. But historically, the UK market tends to see almost double growth, doesn't it? When you look at that. So I think most times when we look back in history, we do kind of, or I certainly kick myself about not buying sooner. And there's that old saying is that don't wait to buy property and wait, and you'll see the growth. And I think that's exactly right, Keith. I think if you can utilise or find all of those kind of key things, the right area, with the right infrastructure, the right developers, always key as well, make sure you're working with the right person, and then utilise the right financing options with that debt, with the mortgage. You could make some really savvy investments at the moment in the UK market.
So then you did touch on before, like the payment plan with comparing, say, the UK with Dubai. And I know, what would you say is the difference between Dubai and the UK, and why you would look at Dubai, why would you look at the UK?
I think it comes down to your appetite for risk. I think if you look at the UK, one of the key reasons why investors choose to buy property there is stability. And not just stability of the market, but the legal framework around it, stability of its economy. If you look at how resilient it is through Brexit, through the pandemic, and seeing those growth figures that you showed me today in the report of, say, London and the other regional cities, and how much they've driven. Whereas Dubai isn't as old. It's a relatively new city and new country, as United Arab Emirates, I think less than 50 years or something like this. And you can see the roller coaster effect of Dubai. And the markets there are slowly becoming more and more stable, but incredibly driven by, say, tourism as a good example. And we've seen unbelievable growth there as well. But it's also hard to predict what's next for Dubai. It's a bit of a gamble, I would say. And if your appetite for risk is moderate or high, then Dubai is a good place to kind of hedge a bet of high capital growth and strong rental yields. But at the flick of a switch, that could disappear tomorrow, economically, or something happens in that market, we see a drop again. Whereas the UK, although it does have lower to moderate yields and a steady growth path, it's somewhere where you can put cash and almost sit back and don't worry about it for 10 years. And I would say that comes into it as well, is what's your life cycle of buying this property? A lot of people think about the purchasing and how much growth you're going to make, but what's your exit plan as well? And I think with Dubai, I would say the exit plan is probably a few years to 5 years, and then resell model and go again and start finding these new pockets or new areas within the city that are being developed. Whereas the UK, I'd always say, is a kind of minimum 10-year plan. I wouldn't really suggest it's a flipping market because of the taxes and the different costs involved when buying, but all of that makes it such a stable market that if you've got cash and you want to put it in an asset that is historically proven, then the UK market's a good one to sit on for 10 years. So it comes down to that. I think risk assessment of how much risk you want to take, and probably the age of our clients as well. Perhaps if you're a little bit younger, you've got a bigger risk appetite, whereas if you are heading towards retirement, you work so hard for that cash, the last thing you want to do is put it in something risky. You want to have residual income coming from a stable asset, and I'd say that's the UK.
Thanks, Jack. I think we've pretty much covered what we were aiming to do on this, and it's been really
Well, thanks for having me.
enlightening, and I hope the football team does better next year.
I do as well. Yeah, thanks for mentioning that though. I was enjoying today until you brought up the football, but yeah.
So I hope everyone else has enjoyed it. We'll put some more podcasts together, hopefully, on that. But I think, Jack, thanks for enlightening. We'll put some information on that. People can contact you if they're looking to start or enhance or do something with the UK property. I'll put that on. We'll put it all on the podcast and everything for everybody. So again, I'd just like to thank you for the time.
No problem.
Thank you for everybody who's been listening and watching. And
thanks. I hope to be back again soon.
Okay. Thanks a lot, Jack.
Thank you.
Thank you.